I'm Kirby Davidson, President and CEO of the Graduate School of Banking, and thanks for joining us for this session of our Distinguished Speaker Series. This year, we're offering our students 4 distinguished speakers that they can listen to at their leisure and also share with others at their organization as a thank you for participating in this year's program and having a student within the Graduate School of Banking program. I do want to take a moment and I want to thank the sponsors of this year's Distinguished Speaker Series. We have the Financial Manager Society, Bank Talent HQ, the University of Massachusetts Amherst Eisenberg School of Business, Wipfli, the Federal Home Loan Bank of Des Moines and the Federal Home Loan Bank of Chicago, the University of Nebraska College of Business and their Master of Business Administration, and Open Lending. We certainly appreciate their support, and many of these have been sponsors of the Distinguished Speaker Series here at GSB for a number of years. So a special thank you to all of them for sponsoring again this year. And with that, I want to turn it over to our speaker today, Julie Stackhouse. And Julie is a GSB Wisconsin graduate who went on to a very successful banking career. Julie spent 32 years with the Federal Reserve Bank of Kansas City and was originally hired as a bank examiner, receiving her examiner's commission in 1983. She quickly had the opportunity back in the early 80s to put her skills to the test by addressing many critical banking issues like the energy crisis, agriculture, and real estate. Over her 30-plus year career, she worked her way up through the ranks to Executive Vice President for bank supervision, credit, community development, supervision, and learning innovation. She just retired in February of 2020 and is now living in Fort Collins, Colorado, and has since joined the board of directors of Simmons Bank and Simmons First National Corporation in Pine Bluff, Arkansas, the board of Miakova, a St. Louis-based financial technology company, and also working closely with the City of Fort Collins City Commission and the Colorado State University Foundation Audit Committee. She also conducts accreditation reviews of state banking departments for the Conference of State Bank Supervisors. So as you can tell, she's slowed down a lot since she's decided to retire. With that, Julie, welcome, and I'll turn it over to you.
Okay, Kirby, I am going to share my screen with everyone, and hopefully I've done that successfully. Of course, I have to start with sharing a picture with you. This is my grandson, James, my first grandson. For those of you that are watching, you're probably thinking about your kids, but someday you'll be thinking about your grandkids. This is really special because my daughter was married in June of this year in Estes Park, Colorado, and James was the ring bearer. I bet you can guess by looking at this picture that a ring bearer with a binky and a comfy blanket is probably not going to follow directions. And he didn't, but it was delightful anyway. So enjoy your kids and someday enjoy your grandkids. I'm going to go ahead and go to my main presentation deck. Kirby gave you an outstanding overview of my background. I hope some of you remember my name from a program called Ask the Fed, which was a Federal Reserve and is a Federal Reserve webinar program for banks and bank holding companies. I really wanted to, at the top of my presentation, encourage you to think about joining the alerts for that program. Now, part of it is because I'm very proud of the fact that I was able to conceive it and get it off the ground in a quasi-bureaucracy, but also the relevance of the sessions for you as bankers is amazing. And in fact, the next 2 sessions will talk about succession planning and also an overview of the energy industry. So just my little pitch at the beginning that leveraged some of my work at the Federal Reserve by staying involved with some of these programs, and hopefully they'll be of help to you. But I want to talk today a little bit about some of the challenges and opportunities facing the banks and financial organizations for which you work. Certainly in my 32 years with 3 Federal Reserve banks, I saw all sorts of challenges facing banks, and particularly community banking organizations. But as happens over time, demographic forces come to bear. And I think particularly over the last 10 years or so, we've seen those forces. Some of my perspective has been heightened by joining the board of a small regional bank and also a financial technology company. And I think what I've been able to see in those roles will be helpful to you. So I've titled my presentation, Battling the Forces of Demographics, Fintech and Big Tech, and Implications for Community Banks. So I'm going to take us back, oh my gosh, 13, 14 years. But there really was a major change in our financial services industry as we look back to the housing crisis that peaked in 2007 and 2008. Some of you may not have even been in banking at that point in time, but for many of us, as we look back, we saw a change in our financial system that blew our minds. It wasn't just a financial crisis that affected segments of the country. It was a financial crisis that affected the entire world. And that financial crisis was largely created by unsafe lending practices in the US mortgage market. But as it went, by September of 2008, we had a situation where over 19 days, the federal government took over Fannie Mae, Freddie Mac, the two largest players in the mortgage market, very important to you, put them into government conservatorship. They remain in government conservatorship even today, allowed Lehman Brothers to go bankrupt and learn the incredible challenges of the worldwide ripple effects of an international firm bankruptcy, and then steered Washington Mutual, which now is the largest technical bank failure in US history. Now, granted, that was immediately merged, but pretty amazing to see that happen in 19 days. What also happened, of course, was that the economy was severely impacted. It was hit very, very hard. And for a decade, I think all of us felt the challenges of that impact. What I'm showing you here is just simply the difference between two interest rates. One, the old, now I'll call it old LIBOR rate, the London Interbank Offered Rate, which we look back and know was misreported at the time. So the numbers were worse than what we see here, and a rate called the overnight index swap rate, which is considered to be a risk-free interest rate. And if you look at the difference between the two, so take the LIBOR rate, subtract the OIS rate, what you would like to ideally see is a flat line. That just means that financial markets are doing pretty well. And until July of 2007, we had that nice flat line. But beginning in actually August of 2007, the financial markets began to realize the risk in the housing market in the US. And we saw many, many challenges over the course of the next year, culminating in the big crisis in September of 2008. Now, if you want to have some perspective on this really sharp rise in the difference between these two rates in September of 2008, you can think back to September 11th, 2001. And obviously a very challenging crisis with the World Trade Center. I happened to be in New York at that point in time, so clearly remember the fear, uncertainty, and just alarm about what our country might be moving into. But even then, for 2 days, financial markets were largely disrupted. But the difference between those two interest rates went to 100 basis points, and they were properly reported. If we look at September of 2008, you'll see it's 350 basis points and was probably more. So that's what a financial crisis looks like on a chart. Important to remember because that really set the stage for major change in the structure of our financial system in the US. So this little slide gives you a sense of some of the bigger players that received government assistance or failed throughout the housing crisis. Those names just don't exist anymore. The government, well, Fannie Mae and Freddie Mac exist, but of course, as I said, remain in conservatorship. But here's the bottom line. $10 trillion in financial assets were touched by government hands in that financial crisis, requiring that the financial system be addressed in a very significant way. Now, a little bit on what the Fed did, and I wanted to talk about this because you're probably still scratching your head about what the Fed did during COVID. So it's easier to understand that if you look at what the Fed did during the financial crisis. And from the housing crisis, the Fed really did two things. First of all, it addressed the panic in financial markets. If you see the circle that is labeled lending programs, those are emergency lending programs that the Fed introduced, many using a provision in the Federal Reserve Act that had not been used since the Great Depression. And then as financial markets calmed, and they calmed once the Supervisory Capital Assessment Program, or SCAP, was introduced, and financial markets began to believe that large financial institutions would not fail, then the Fed stepped in with quantitative easing. Now, quantitative easing is just not all that hard to understand, but if you think of it this way, which is the Fed typically handles monetary policy through adjusting short-term interest rates, the federal funds rate. But when that federal funds rate hits zero, you say, well, is the Fed done? And the answer is no. What the Fed did is began buying long-term government and government agency securities through a process called quantitative easing. And that process spurred the economy by reducing the rates on long-term securities. So you can see, the bottom line is the Fed's, and this is a picture of the Fed's balance sheet in a graphical form. The Fed's balance sheet went from under $1 trillion to, at the height of quantitative easing, up to, well, it goes on beyond here, but eventually it went up to $4.5 trillion. So pretty significant intervention by the Fed, and both long-term and short-term interest rates were brought down in a significant way. Now, here's where some of the effects to banks were felt. And how many times did I hear community and even small regional banks say, we did not buy or make these bad mortgages, but we're feeling the effects of it. No question about it. And almost all situations had to do with community banks making land development and construction loans in a very hot housing market where credit was very easy. And once the bubble burst, then those construction and land development loans quickly soured. And banks that were concentrated in construction and land development loans failed very quickly. You'll see over the course of the post-housing crisis that over 500 smaller banks failed. Now, I lived through the financial crisis or the banking crisis of the 1980s, and we had over 500 banks fail too. But at the time, there were many thousands more banks. As we moved towards this crisis, we were working off a base of just over 6,000 banks. So 500 community bank failures was very significant. And again, the vast majority due to lending in construction and land development loans. I did a series for bank examiners before I left the Fed where we went out and we interviewed both bank examiners and bankers that lived through the housing crisis to codify the lessons learned. And I think the big takeaway, it was everyone, is if you were going to make it through a crisis like the housing crisis, you needed to have two things. Number one, you needed to be very careful in your concentration of CRE loans, commercial real estate loans, but particularly construction and land development. And second, you needed a core deposit base, because if you were funding those loans with purchased money or hot money, inevitably that source of funding would dry up as your financial condition deteriorated. And at that point, there was just no ability to raise capital. But the picture is clear. The financial industry changed not only from the failure of large financial organizations, but the failure of small financial organizations as well. So, as happens with every banking crisis in the United States, there's legislation, and the DoddFrank Act was the congressional response to the housing crisis. It had many reforms, many of which hit community and regional banks as well as large banks, particularly in the area of consumer protections. But it required, importantly, that large banking organizations, the very large banking organizations, those above $50 billion in assets, now raised to $100 billion in assets, that they increase their capital and that they increase their on-balance sheet liquidity. And that has been very successful and, frankly, in my view, very important as we moved into the COVID crisis. What you can see in this chart is the green line, which is banks and bank holding companies under 50 billion in assets. And throughout time, those organizations have largely had strong capital ratios. But if you look back at the time of the housing crisis, 2008, you'll see that the large organizations held very low levels of capital. And today, if you look out, you'll see that the capital ratios, while not exactly at the level of smaller banks, are pretty close. In short, we have a very strong financial system in the United States, and a lot of it incented by the requirements of the DoddFrank Act. So what has sort of happened? I've set that up to give you a sense of what the impact has been. And I think it's pretty easy to see that the impact has been a decline in the number of independent banking organizations in the United States. Now, not just because of the housing crisis, of course. There have been numerous factors in place. But if you take a look at the first chart in the upper left, and this comes from the Federal Reserve Economic Data, or FRED, if you ever want to chart anything cool for a meeting or whatever your purpose may be, FRED has data of all sorts and is very easy to chart. But I've pulled the trend in banking charters, and you can see that I've gone back to as far as the mid-1980s, that there's just less banks, substantially less banks, starting at something over 14,000 and today under 5,000 banking organizations. Certainly, there have been some factors that have driven that in addition to economic factors. Perhaps the most obvious is the introduction of interstate branch banking, where many independent banking organizations under the same holding company were consolidated into one bank with many branches. But if you take a look at the right-hand side of the chart, you'll see that the decline, if it has not steepened, it's certainly returned following the housing crisis, which means there's just less banks, and less banks off a smaller base means that there's something affecting the decision-making of shareholders of banking organizations, incenting them to sell their charter to someone else. Now you may say, well, okay, so if there's less banking organizations, does that mean that there's just more branches? And it used to mean that, particularly as we moved prior to the housing crisis. It seemed like every time there was a bank consolidation, there was just another branch. But boy, did that start to change. And the chart in the lower right-hand corner gives you a feel for what the demographics are. And you can see how quickly the change in branches has occurred since the housing crisis, with banking organizations rethinking their banking strategy. Now, I am certainly not an anti-branch person, although I'll admit I've not gone into a bank at all for many years. But I think there's a reason to have branches if customers want that type of service. And in many of your communities, particularly smaller communities, they do. But in other communities, and I would say especially certain urban communities, the benefits of using technology are outweighing the benefits of visiting a physical facility. And that demographic, the interest in the technology, is also likely driving some of this change. So we'll see. I know that there are some organizations, particularly credit unions, that continue to construct branches to make it presumably easier for their customers to receive service. And, if you've run the numbers and that's true, I think that's great. On the other hand, you want to make sure that that's true, because a physical facility is a very expensive way of advertising your name, and there might be more efficient ways to do it. But you can see the trend, even branches are declining. So let's look at some of the reasons for that, and then we'll turn a little bit to technology and how that matters in your thinking. So when I was at the Federal Reserve Bank of St. Louis, we introduced an annual community bank research and policy conference sponsored jointly with the Conference of State Bank Supervisors and later the Federal Deposit Insurance Corporation. And the whole purpose of establishing the conference was to encourage scholarly research on matters of interest to community and small regional banks. Economists like and need to present papers that they prepare, and having a quality conference to be able to offer and present those papers was important. So that's what we did. One of the complementary activities that occurred as part of it was a survey of community bankers. And that survey asked typically the CEO of community banks a number of questions on factors affecting the operation of their banks. And one of those factors was total compliance expenses as a percentage of non-interest expense. So in other words, of the stuff that you're doing that's kind of support and overhead, how much of that has to do with compliance expenses? If you take a look at this chart, you can just visualize by the size of banks how disproportionate compliance expenses are as a percent of non-interest expenses for small banks. So the left bar, which is banks under $100 million in assets, roughly 10% of non-interest expenses are attributed by survey respondents to compliance expenses. That drops to about just over 5% as you start to hit that $1 billion in size. So economies of scale are at play. There are just fixed costs associated with compliance, and the smaller you are, the more burdensome those costs. Now, it's a huge challenge. Those, as bankers have told us, those costs tend to go into things that, are pretty hard to argue against from a public policy standpoint. Costs such as consumer compliance, costs associated with Bank Secrecy Act, anti-money laundering. It's as one official told me once, just because a bank is small, it can't treat its consumers worse. Now, I would argue community banks are pretty good at treating their consumers well, but the costs are there, they're fixed. And if you have a very small bank, it is affecting you disproportionately more than larger banks. Other things that are affecting many banking organizations, and it could be yours, are just changes in demographics. So if you take a look at the first chart, this was pulled from the USDA, you can see that it shows the year-over-year population change in different markets in the United States from 1976 to 2017. And the red line is non-metro markets. So it's not exactly farm, and it's not exactly going to be markets that fit perfectly with where you may be located, but it gives you a sense of the difference between metro markets, the blue line, and non-metro markets, the red line, on what's happening with population changes. So as you get through the 1990s, things were pretty similar. But as you start to move into the 2000s, and really until 2016, you'll see that the population change in rural markets was substantially less than metro markets. And by the time that you reach 2013, population change was negative in non-metro markets. Now, what did COVID do to this chart? I think it's probably anyone's guess. Definitely metro markets took a hit during COVID as more people work from home. Whether that is a lasting effect, I think, has yet to be determined. If we look at the right-hand chart, you can just see a picture of the US where we have non-metro markets and population changes from 2010 to 2017. It's not on the East Coast for the most part. It's going to be upper Midwest, some of the Western states, definitely more rural communities, are experiencing the Western states are still, excuse me, I had that backwards. The Western states are still experiencing some population growth, but in the Midwest, lots and lots of population losses in particularly rural communities. And you're probably not surprised if you are in one of those rural communities, particularly an agri-community. You probably are also seeing agribusinesses consolidate, and that requires sometimes a different type of banking for those particular populations. So those factors are real and there. It would be nice if we could change the trajectory of the preferences of people. I don't think that's possible. So instead, we have to plan for what's next if these demographic changes continue. And another factor at play is continuing low interest rates. So I gave you the picture of the Fed's balance sheet a little while ago and talked about how the Fed introduced so-called quantitative easing, purchase of long-term bonds to really return the economy slowly to health following the housing crisis. And you can see by this chart that quantitative easing, the purchase of these long-term securities, ended in 2014. And then it stayed at that level until roughly 2018, where the Fed very slowly started to reduce the size of its balance sheet, allowing those securities to mature. One of the big lessons learned in allowing that to happen was that the liquidity requirements of many very large banking organizations really demanded that the Fed have a bigger balance sheet than it did in years past, because many of the required liquid balances were held in reserve accounts at the Fed. So the Fed really tried to calibrate what it could and should do with respect to changing the size of its balance sheet, and was working on that process as we got into the end of 2018 or into 2019. And then COVID hit. COVID was pretty awful for all of us. I think as a central bank, y'all should feel pretty proud of the Federal Reserve's response. Financial markets were initially very, very concerned, alarmed about the worldwide economic impact of COVID. The Fed acted very quickly. It expanded its balance sheet very fast to stop panic. And now we're looking at over $7 trillion size balance sheet, if you look at the left-hand side. But I think largely people don't even remember that financial markets were disrupted. So that the Fed has introduced and is continuing today that quantitative easing program. If you are wondering what's going to happen to interest rates, I hope you have your crystal ball. It's always hard to know. We all understand the inflation pressures that are seemingly out there for the consumer, and many would be concerned that perhaps the Fed has moved too slowly on its decisions with respect to interest rates. If I were to give you any advice such as it is, I would say, the first thing the Fed needs to do is decide to stop expanding its balance sheet, stop quantitative easing. I think that's reasonable to expect that that will occur soon, probably within months. Then the Fed has a separate decision on whether or not to raise short-term interest rates. At those interest rates, the Fed funds rate will be raised largely due to an expectation that inflation pressures are out there and continuing. It's very hard today to know what's really impacting inflation. If it's pent-up demand chasing services that have yet to get back in full gear, if it's the impact of extended unemployment benefits, or if it's just truly sustained increases in prices. But toward the end of 2021, I think we'll all have a better feel for that and a better feel of what the Fed's intended goals are with respect to short-term interest rates. Currently, the projection is for no short-term interest rate increases until 2023. But at each meeting, the Fed, or each quarter, the Fed puts out a new projection. So be sure to watch those. In any event, means we have long-term low interest rates. And for many community banks, that's a challenge, as customers are still increasingly shopping for the lowest loan rate, while deposit rates have bottomed out. Okay, and the final factor, and where we're going to go next, is just what's happening with consumers and businesses, and that is They are just wanting, desiring, demanding technology. So if you haven't seen this chart from the Pew Research Center, it's a pretty good reminder, and particularly I'll direct your attention to the smartphone chart. So I'm a baby boomer, and we like technology. Some 68% of us own a smartphone. But man, the millennials and the Gen Xers, they're way out ahead of us. And I don't think there's no going back for them. If you have kids old enough to set up their own bank account, you either did it online with them, or they did it online, or if you did take them into a bank, that may be the only time they go into a physical facility. They are wired for technology, and frankly, so are we. We're getting very used, particularly post-pandemic, to having the luxury of being able to buy our goods and services online and have just that little bit more time for doing something else. So that habit, I think, is probably fully ingrained at this point, which means that banks need to think about their own services for customers. And that leads us to financial technology. I'll open it by saying this quote made by Jamie Dimon a few months ago, I think, was useful. Of course, Jamie Dimon is CEO of JP Morgan Chase, pretty large banking organization, and his comment to shareholders was that financial technology is an enormous competitive threat to banks. And he put it in the context of saying that these big tech companies, and he specifically mentioned Amazon, Apple, Facebook, Google, and Walmart, are here to stay. I think that's right. But importantly, that they've been able to find that magic integration of social media, data, and data analytics, using the data to know what you want before you know it, and ability to integrate with other platforms very quickly. And that data in particular, combined with social media, the interaction with others, is just a winning edge in his view. So if you haven't spent some time talking about fintech, I'm going to give you just a very quick definition of it, and then we'll go into the banking implications. A lot of definitions are out there on fintech. I'm on a working group with the American Bankers Association that is looking at digital assets and central bank digital currencies. And, one of the first questions was could someone develop, really just a set of terminology of all the aspects of fintech? And I'll admit I was a skeptic on that, mostly because, first of all, different people have in their minds different ideas about what is fintech, and you can't make someone adopt a definition that they don't feel is right. And second, it's always changing. So it's very hard to come up with a standardized set of definitions when the technology continues to emerge. But the bottom line is, it's just really technology that either makes faster or streamlines or digitizes traditional financial services. It is a new way of doing traditional businesses that allows technology to be the driver. And that's not so hard to get your head around when you think about even things like your own shopping patterns, for example. If you use Amazon or something similar online, it's probably just more convenient and easier and nicer than getting in the car and driving to a store that could be miles away. Well, that's sort of financial technology too. How do we make these financial services easier and more desirable? To give you a sense of how many of these are out there, there is data published by Statistica.com. I pulled it as of February of this year, and the Americas, North and South America, had something over 10,000 fintech startups, making it the region with the most fintech startups globally. That also makes it very hard for you as a banking organization when you're looking at these services, because many are not going to make it. It is still a nascent area, and lots of money out there chasing or available for startups, but obviously there will be a lot of churn, with some startups being very successful, some startups failing, and other startups merging as maturity comes to this particular industry. For you, I want to simplify fintech into 4 categories and hopefully touch on each of these. At least, it's a way to more surgically think about fintech. And I've broken it into 4 areas. So one area is customer-facing tools. This is the stuff you give your customers. Back in the day, it was your website, an online banking. Today, it's your apps. It may be your online account opening services. It may be the ability to, even in some cases, execute a loan online. It could be your card services. But all of these are tools that allow the customer to do their banking from typically their phone, but also potentially from their desktop. A second area is operational efficiencies and data enhancements. And I think this is one that would be good to take back and discuss at your bank. The technology has developed to the point that there is the ability to really think about process automation. There are a lot of tools, certainly workflow tools, that have been out there for a while, but there are other tools that, with the right investment, allow computers rather than people to complete tasks and typically complete them with greater efficiency and accuracy than people might do. It's a little scary in some ways. Just to give you an example, at the Federal Reserve Bank of St. Louis, we looked at, could we improve the efficiency of processing your call reports? And there definitely are ways to do that. And data analytics, artificial intelligence, that would probably allow us to do it better than the traditional edit resolution process. But as you get into tools like artificial intelligence, you really want to understand what the tools are doing. And there are many times in many organizations a limited number of people with that particular skill set, and also wanting to be sure that the tools don't have any biases that would emerge when data changes over time. So that's hard. But the other part of it is the people hard. People are very fearful that technology will reduce the need for their jobs and need to be reassured that the advancement of technology, it brings value to an organization, and it could certainly change jobs. But people also have the ability to reskill and do other jobs if they're inclined to do so, and they need to be comforted that that's an option for them. The third category, banking services provided to fintechs, I'll get into in some depth in a minute. Some refer to this broadly as banking as a service. There's lots and lots of definitions of banking as a service, but I want to be sure that you have a sense of all the risks you need to think about when you get into it. And then I'll land on digital ledgers and virtual currencies, which always get some attention, but I think this summer have probably gotten a little bit more attention. So let's start with the customer-facing tools. And I've just put a laundry list of things that I think are going to be most used in the financial services arena over the upcoming years, if they're not already offered by your bank. The bank where I sit on the board, Simmons Bank, has recently introduced an online demand deposit account opening service. Needs to be done very carefully. Absolutely understand that many of you work with core processors, or you may work for core processors, and these integrations are require an understanding of technology that may not exist in every banking organization. Yet, if you don't have the right technology, consumers will not want the service. And so you have a little bit of the chicken and the egg. It's got to be really good technology. You've got to be able to open a demand account, for example, in 5 minutes or less. Otherwise, probably not even worth it to offer the technology. So a lot of strategic thinking needs to go on as you look at offering these services. I mentioned loan applications in a few clicks. Obviously, there are many internet options for personal and small business loans. Banking organizations, too, are looking at ways to offer these to their customers. The Fed did a small business survey, regularly does a small business survey, and typically asks why small businesses use these non-banking loan applications. And, there's a variety of reasons. Many have been turned down by banks, so that's a credit risk issue. But others, it's just the fact that in running a small business, they're very busy during the workday. And the idea that they can look at their business finances at night when banks typically aren't open is very important to them. So knowing your customer is key. Person-to-person payments, wow. So I'm probably half of you are big, heavy Venmo users, or if you're in my generation, your kids are big Venmo users. I am not a Venmo user, by the way, simply because of I'm not as interested in the social interaction as users of Venmo are. And I prefer to know where my data is going. So I'm one of those consumers who's going to use Apple's Cash application, since I know the data is mine and not being used by others. But the idea being that you don't have to come up with cash to pay for the dinner arrangement is sort of the way it is with many generations. And there are also going to be different peer groups that prefer different payments services. So I mentioned Venmo, which is obviously a pretty popular service. Cash App, which is Square's person-to-person payment service, tends to have a heavy utilization in the Hispanic population. And I make that point not to say that there's a different service or different opportunity with the different apps, but you're probably going to want to use the same one as your family and friends. And so the bank app Zelle, which many banking organizations offer, likely will be used by individuals who have a close affinity with that banking relationship and who really care about the fact that that deposit is always insured, not sitting in an account somewhere where it has to be moved to a bank to be insured. So could we do consumer education and fix all this problem? I don't know. I don't know that consumers really care on some of these things. These balances are oftentimes not huge. And apps such as Square's Cash App even work to provide accounts behind the scenes for individuals who don't have their own account. Rather, I think it's just a matter of saying it's going to be a really messy market. And we may find that there's 4 or 5 alternatives that are used by groups with similar interests, but may be hard to cross the line across apps. I also mentioned feature-rich card management. Your bank may well offer a credit card service, and that's great. As a consumer, I want a lot with my credit card service. As you've probably all guessed, I'm a big Apple fan. As I say often, Apple sent my kids to college, buying stock very early. But more than that, I like Apple's privacy policies. So that's kind of the direction we've gone. And later I'll show you kind of Apple's card and its interbank arrangement. But importantly, in this case, what I really like is the fact I can see every purchase immediately. In the case there is a fraudulent purpose, it would pop up. In fact, Apple's algorithm or Goldman Sachs algorithm would probably tell me there's a potentially fraudulent payment. And then I can go right into an online chat or initiate a person-to-person conversation if that's what I want it to do. But I can do it all on my phone. And for me, that's pretty cool. Plus the fact if my card number is compromised, I can just get a new number without having to get a new card. The list goes on with many other tools, with merchant payment services, notifications, some great advertising lately about, oh, your account balance is getting low. You don't want an overdraft, so you need to take action now. That is very attractive to consumers and not likely to decrease in attractiveness. But at the end of all this is the ability to converse with a human if you really need to do that. And most that use technology don't really want to do that all the time. But if you have to do it, you want to be able to do it and you don't want to be on hold when you do it. And finally, and your customers are doing this whether you understand it or not, But that is that they're integrating with third-party service providers, either through an application protocol integration or through providing their login ID and credentials to your bank's account to these third parties. So we are in the midst of a secular change in financial services. These are some of the things that are very attractive to consumers. They may not be things your bank offers now, but probably will be things your bank will be talking about in the not too distant future. Second area, I talked a little bit about operational efficiencies and data enhancements. And the thing that I want to probably point out here is the data. So banks, particularly smaller banks, have traditionally relied on core processors and stored a great deal of data in those core processors. And if that's working for you, that's great. The challenge is that there's a lot of data that's not in those core processors. Sometimes it's in a spreadsheet, sometimes it's in a desk drawer. And that might be the best data that allows you to understand this idea of knowing what your customer wants before they know it. And I'm pretty confident that over the upcoming years, we're going to see more and more services that allow data to be taken from many places, core processors, but also all of the very informal data, or much of the important informal data kept by banks, bringing it together, normalizing it so it's useful, and allowing for advanced data analytics so that you're able to see the performance of your bank in ways that you haven't seen before. And you're also able to predict what customers might want. It's certainly not mature technology at this point, but it's emerging. And to really be able to compete with big tech, it's going to be something I think that's going to be increasingly important. There are ways to streamline back office processes that I mentioned earlier. Paperless offices, records and document management. If you haven't worked towards even moving your credit files, loan files, into an electronic format, probably something to put on your strategic plan, since increasingly the regulatory part of banking examinations is going to become more and more electronic. But also the idea that tools like artificial intelligence and machine learning will become more prevalent. So the big one that is talked about a lot is in Bank Secrecy Act, anti-money laundering. In working with Simmons Bank, I have a pretty good understanding of the frustration and challenges with the paperwork involved in BSA AML processes, even though to some extent it's automated. There's unnecessary suspicious activity reports being filed. And frankly, just the limited amount of data may mean that some transactions that should be reported just aren't being identified. And tools like artificial intelligence and machine learning provide the opportunity to improve those processes, particularly if there would be some effort at a national level to bring data across banks together. So a broader swath of data could be used for these tools rather than just bank only or vendor customer information only. So more to come on that, but a lot of things to talk about there. And I'd say if there's one takeaway, it's, you probably do want to start working towards that paperless office, at least for your loan files. And second, really start to think about what do you do with your data, and is there an opportunity to better meet your customer needs and improve your operational efficiencies by improving the quality of data outside of that which sits in your core processor systems. All right, so let's move now to what might be the more interesting area to you, which is banking services provided to fintech companies. I continue to be amazed at the comments I hear about fintechs challenging banks, and they are. But let's be clear. If a financial technology company isn't a bank or doesn't own a bank, then it's using a bank. It has to have access to the clearing and settlement system. So Square, for example, recently purchased an industrial loan company in Utah, and it is essentially operating a bank. Now, it made a lot of commitments to the Federal Deposit Insurance Corporation about operating that bank just as you would operate your banks. But I think you all feel like that's fair. If we all have the same set of rules, then that's fair. There are others, though, that are using banks. So here in the sort of middle of the slide is a picture of my Apple card, my Apple credit card, and you'll see that that is actually a Goldman Sachs card. So even though it is on my Apple phone and I automated it through that feature, my card is issued by Goldman Sachs. And when something does happen, I'm talking to a Goldman Sachs representative. So that is a partnership between Apple and Goldman Sachs. On the right-hand side, I've used another example, Chime. So Chime does a lot of advertising about their services being more friendly to customers. At least that's how they advertise it. Customers feeling confident that they know what their balances are at any point in time, and just a friendlier vibe, I guess, with this particular service as it's advertised. But if you go to the Chime website, you'll see that the banking services are actually provided by the Bancorp Bank or Stride Bank, which are banks. So there are technology integrations with those banks, and they are actually behind the scenes providing the services to the customer, but to the customer, it looks like it's a Chime bank. So that there are many ways that fintechs will look to banks for services. It can be for deposit accounts, and many times it's just the balances. So Venmo needs banks to store those balances held in Venmo accounts. It might be for customers individually. So Square may go to banks to set up accounts for customers who are otherwise unbanked for its Cash App services. It could be through for card services, as I illustrated with my Apple Card. Clearing and settlement, just simply, if you're going to make a loan, then you've, as a financial technology company, unless you want to go to the private sector market to fund that loan, you are going to look to a bank to originate it, and then it will move somewhere for funding and settlement. And just generally, settlement of financial transactions. So lots of reasons that financial technology companies need you. So what do you need to think about? It depends what area you're looking into, but go in with your eyes wide open. There are going to be fees charged by banks to financial technology companies, and because of the volumes of transactions involved, it's going to look a bit like a very attractive source of revenue. But you do need to think about the implications for your bank. You need to think about that financial technology partner as really being a offshoot of your bank. So the risk they are taking on, you have taken on as well. So first of all, there's technology risk, of course. Anytime that there is an integration with another provider, you've got one more link in the chain. And we know that cyber risk is going to be the weakest link issue. So you really do want to understand the strength of the cyber program and also the ability of your cyber program to be able to handle the technology involved. If you're in the lending space, fair lending, if you are originating those loans for a financial technology organization, you have assumed the fair lending risk. And so you've got to be able to understand both how those loans are being originated by the fintech company, but importantly also the handling of consumer complaints. They may not all be going to you. Some may be going to the fintech company, but you need to understand all of them, not just the ones going to you. And that requires that the fintech company provides you with very good information on handling of customer complaints, and it should meet the standards you set for your own bank. Unfair and deceptive acts and practices, if that contract says that something's going to be done, then you've got to hold that fintech's feet to the fire and make sure that it is done. Otherwise, it will be a UDAP issue for you as well. Similar with fair credit reporting. BSA AML, there are lots of customers that are involved with these fintech companies, particularly as you look at something like Chime, and they have all the same obligations of knowing their customer because it's your customer. And so understanding and enforcing the strength of a BSA AML program as much as you would in your own banking organization is going to be key. Liquidity management is another factor. So there are a few banks that have gotten involved in digital currencies and working oftentimes with the exchanges, Coinbase and the others, to hold the dollars as those are exchanged for digital currencies. There's going to be a pattern of those balances being held in banking organizations and how they move. And then there's going to be a stress situation where they move differently. If you're going to get in that business, you're going to want to understand perfectly those stress scenarios and be testing them regularly. And finally, good old credit risk. We see many banking organizations buying, particularly consumer loans, being originated by fintechs, and that's fine. But you've got to know the standards under which those credits are being extended, if your standards are not the ones being adopted. And of course, you got to make sure, as we said earlier, that the practices are fair. So that gives you some of the different factors. My advice to you is that if you're going to get into this involvement, bring together a cross-functional team at your bank, the technology people, the BSA, AML people, the operations people, could be the credit people if it involves looking at the financial health of a third party or its customers, and develop your strategy with many minds at the table. This definitely is a multifaceted, it will be successful if it's a multifaceted approach. Now, there are more companies out there looking to essentially, or their strategy is to allow banks to plug in to fintechs by using a third party who arguably is going to do these due diligence services for you. And that's not bad or wrong. You just have to understand what they're doing and whether or not what they're doing meets your standards. Because again, as a third party, it ultimately means it's your responsibility. And speaking of your responsibility, if you're going to get into this business, I encourage you to read the proposed regulatory guidance on risk management of third-party relationships that was announced by all the federal banking agencies on July 13th of this year. It does provide guidance on management of third-party relationships. It speaks to a life cycle of working on those relationships, starting with strategy, then going to due diligence, contracts, board of directors oversight of risk management processes, third-party monitoring, and then, and quite importantly, contingency plans for terminating the relationship in an effective manner. And terminating it can cut a couple of ways. One is you're just unhappy with what your third party is doing. But the other side of it is, since many of these are startups, and that's fine, it's possible that they will change, either not survive or be merged with another organization. So you have to think about these relationships as being a continuum and not static. Do take a look at that. The comment period closes September 17th, 2021. The regulators have said that they're going to align their expectations sort of with the activities of the organization. So if you truly are a plain vanilla banking organization, that's translated to mean that regulators are not going to look as closely as they will with organizations that are engaged heavily in some of these activities. And when I say heavily, it's always relative to the size of your organization. So good advice in there, and gives you a good sense of how to think about third-party relationships with fintechs. And finally, I'm going to close out my session today talking a little bit about digital ledgers and related technology. I laughed because I was at my hairdresser's a few months ago, and the young lady said, "Oh, I know you're a financial person. I'm so excited. Elon Musk just mentioned Dogecoin." And so I went and bought some right away. And I said, do you know what you bought? And no, she didn't know what she bought. And I said, well, here's my advice to you is if you've got some house money, some extra money, kind of like the stuff you'd buy lottery tickets with, and that's what you want to do just to see what happens, it's a good learning experience. But if that's kind of your savings, you probably need to do a little bit more homework on what you're doing here. And, so a lot of craze is out there, but I'll put Bitcoin, Dogecoin, and many other coins in the same category as they're experimental. I'm not sold. You may be. I know my son has made some money on Bitcoin. I think that's unfortunate because that only probably increased his interest in it, even though I've counseled him numerous times on what really sits behind Bitcoin, which is largely nothing. I understand that Bitcoin is now considered to be a store of value, and that will be true until the significant owners of Bitcoin sell, and then it will no longer be a store of value. But there are other issues, obviously, which is unclear business purposes. When you're paying ransomware in Bitcoin, you have to scratch your head and say, what's going on underneath some of these services, but also just some of the other issues associated with these currencies, particularly with respect to mining activities and the amount of energy it takes to conduct these activities, literal energy, and so environmental factors. So a lot of stuff out there. You can tell by my comments, I'm not a fan. So proceed at your own risk. If you are a bank that is clearing and settling for these coins, again, nothing necessarily wrong with doing that. They need to do it, but just be sure you understand what the nature of the coin is, the liquidity implications, the management structure, and the risk being accepted with respect to these coins, and have your board of directors actively engaged. Non-fungible tokens was also kind of a new craze this past summer. I put a link here for an NPR story that I thought was particularly good about non-fungible tokens. So the digital ledger used for these things is Ethereum. It's a blockchain ledger. The idea is intriguing, which is that if you have an asset that's not necessarily real, so think of music, for example, and you want to transfer ownership of it and have that recorded, how do you do that? And the idea is you could do that through this blockchain technology. So there's something there, since no one can modify the record or create a duplicate. There would be a record of source. Now, some of the things that non-fungible tokens have been used for during this early period of time is a little weird. And it's not so clear there's a lot of value there, but at least the concept of being able to create sort of your ledger for an electronic asset is interesting and probably appealing in many ways. Also receiving some discussion this past summer was Diem, which is former Facebook's Libra by another name. So Facebook announced several years ago that it was working with a set of firms, not Facebook only, to offer a digital currency. And the sales pitch, it's kind of evolved over time, but the idea is they want to improve the remittance market when you send money abroad. So exchange is very expensive in different currencies, and their goal was to come up with a solution that made it cheaper for merchants and retailers, and that could be done through a blockchain solution using the exchanging currencies of fiat currencies into this Diem currency and conducting transactions that way. So that initially received a lot of congressional attention. It was later restructured. It was actually moved to a different country of origin. It's now called Libra. There are 25 members of the association, so 25 players in the game at this point. Release is still expected this year, but the idea is, can you take some of the friction out of payments transactions by operating in a common virtual currency rather than the country's fiat currencies? So we'll see how that goes. It is what's called a stable coin. You may have read some of the discussion about stable coins and the need for regulation of those coins over time. But I think what's intriguing about it is this idea of trying to improve the international remittance market. And last but not least, FedCoin. I would definitely, this is definitely worth watching. I know your bankers associations are clearly watching it since I sit on one of those. The Fed will issue a paper on this idea of a central bank digital currency. FedCoin is the operating name of the Fed's currency. There was a great speech by Vice Chair Quarles a little while back, where he talked about the concept of the Fed being in a digital currency, the pros and cons of that. So what's my take on it? I think, first of all, there was some stated worry about the Fed hosting customer accounts, and would that put banks out of business? And some in Congress have called for the Fed to host customer accounts for the underbanked or unbanked. Banks do a good job of hosting customer accounts. Maybe could do better. And I think there's a lot of incentive to do better. So I'm not so sure that's where the Fed would independently at least want to go. Now, Congress can do what Congress wants with respect to the Fed. And there would be a lot of issues, like what protections would be provided to consumers, or what would be, how would mistaken transactions be handled? There's just a host of policy questions that would be involved. The thing, though, that I think is probably most interesting is the underlying technology. And is there a way to make payments even faster than what we're used to today using ledger technology? And from what I understand, blockchain technology is not going to be fast enough. So it'll have to be other types of ledgers. It's going to have to be able to withstand something between 1,700 to 8,500 transactions a second. So the computer horsepower is significant, but frankly, I think it's responsible for the Fed to be able to think about and to take on the review of technologies that might serve the financial system over the longer term. So keep your eye on that. I think you'll find it very interesting. So let me wrap up here today by saying a few things. First of all, your consumers are changing, maybe not overnight, but take a look at that millennial and younger generation and what they're doing in your bank, both with respect to deposits and services, and follow them, because they're the next generation of your customer. COVID probably just only accelerated what was already happening. As you start to do that, then getting some time to be able to think through what works for your bank is important. I've used the word urgent. I think it's there because technology transitions take a long time. If you don't have a plan, then being able to actually begin the steps of a transition is just not going to happen. So start with the plan and be better prepared for the transition. It's really it's not about what can be done. You can offer a lot of services, but you need to do the good old business sense test on this. So if you're losing or not getting the deposits of your customers' kids, for example, then you know that to be able to bring in those value deposits, you're going to need to offer the service that you don't have today, and that will bring good business value over the longer term. Ultimately, it's my view that if these good strategies, thoughtful investments are done, they are going to make community banks a formidable competition to big tech, because community banks have always had one advantage, and that is their relationship with the community. Big tech's not going to be able to associate with your communities in the same way you do, through the people that you employ and through the investments that you make. If you can complement that great customer service with thoughtful investment, then you really are staged to be successful in the future. So I am going to stop sharing my screen, and I will give it back to Kirby. Bear with me one moment, Kirby. I've got a little technical glitch here. Hang on.
We are all good,
Okay.
Julie.
Perfect.
Great job, Julie. Thank you so much. A great look back at how we got where we are, and a great look forward at some strategic initiatives and tactics that our bankers certainly can look at going forward as our future leaders within the industry. So thank you, thank you, thank you. As a reminder to all of our students that are listening today, please share this recording with others on your staff that can benefit from listening to Julie's comments and her presentation, as it would benefit many. There are 4 of these distinguished speaker sessions that are available to all of our students and their sponsoring banks this year. Again, as a thank you from GSB for participating in this year's program. So with that, thank you again, Julie. Thank you to our students and their sponsoring banks. Have a great rest of your day.